Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to go over the true value of an option and how you can get closer to that value using ORATS. Matt, do you want to share your screen and get us started?
Sure. Yeah, so this is one of my favorite topics. One of the hardest things that we've done is to try to determine this. So when we say true value, there are a few things that you can think of. One is, what's the profit and loss going to be of options at the end of its cycle? And another is, what's the value of an option given all the other options near it? And so we're going to answer that one, the latter. We're going to answer what the valuation is given other options around options. So it's going to be mainly for trading, when to get in, when to get out. If you're making a trade, especially multiple legs, what is that value? What is that true value based on kind of non-arbitrageable, meaning you can't buy one and sell one, in different months or different strikes and have an arbitrage opportunity. Does that make sense so far, Tyler?
Yeah, it does. It's one of my favorite subjects, and it's a very core tenet of ORATS. I mean, this is the very first step that happens when we ingest the data from our providers, on its way to our clients. So it's one of the first steps, and I'm excited to go over it today.
Yeah, so there are a lot of steps. We're going to get into those and just give you some appreciation for what goes into making this what we call a theoretical value. So a theoretical value is kind of what traders, I was a market maker, and what we used to talk about as the value of a particular option. Now, we also talked about, we also did things like forecasting the value of options. And you could do that, but the first step is to get kind of the good relationships going. Because when you make a forecast, you have to have a historical data set. And if your data set's messy, you're going to have a messy forecast. So the first step is what we're going to be talking about today, and then we'll talk about a little bit of just the overall value of an option. But the first step is the smoothing process, Tyler.
Great. Let's go over it. What do you have up on the screen there? It looks like the options chain for Apple.
Yeah, this is a really good visual. So what we're talking about is really just each expiration. Drawing that orange line, so this orange line through the call, the cyan colored, and put the purple colored implied volatilities. Now you'll see that once in a while one gets off. Often those are from wider markets. Often those are supply and demand, and those are the kind of the problem or the opportunity for a good smooth number to come up with a theoretical value for that. So yeah, the first step that we do when we calculate, what we think the true value of an option is you ingest everything at the same time, you get a good stock price, and then you start to think about, okay, let's do an implied volatility calculation. So that's the first thing. So that's important too, because you have here, Apple is an American exercise, which means you could exercise at any time before expiration, whereas SPX is only exercisable at expiration. So this is an American option, which makes it more difficult, which means you need to do more things like these binomial trees and kind of simulating what end prices of of things will be, and there are steps and all kinds of crazy stuff that you could read about. It's beyond the scope of this conversation, but just know that there are very intensive binomial option pricing models that go into these implied volatilities that we're going to do as the first step. Take an implied volatility of a price. So in order to do that, there are 5 things. You need the stock price, you need the strike price, you need the time to expiration. So all those are kind of known, but then you have like dividends and interest and volatility. So the unknowns are dividends and interest, and so and of course volatility is what we're going to be solving for. So first of all, you need good interest rates, and those are usually pretty obvious and basic, but again, not always. For example, people used to say, "Oh, we just use the risk-free rate." Well, that risk-free rate has been kind of manipulated in markets and such to where the true interest rate paid by market participants is different from risk-free rates. It used to be the euro or the euro dollar, and so now there's kind of a complex interest rate that actually ORATS works hard to solve for. And that's often different from normal interest rates. So that's the first step, is getting a good interest rate. Because if you don't have good interest rates, your implied volatilities of your calls is going to be different from your implied volatilities of your puts. And you don't want that. In order to come up with a fair assessment of implied volatility and therefore valuation, you need to line up the call and put volatilities. That's called put call parity. And that's kind of the first step to do. So far, so good, Tyler?
Yeah, I mean, I think kind of the crux of what you're saying is that this, age-old formula, or these components that go into an option price, some of them kind of aren't what we generally assume them to be, right? And ORATS does its best to find a more accurate version of that through really advanced put call parity calculations with the dividend assumptions, the liquidity assumptions, and what you said about the interest rates.
Yeah. So first of all, we start with, I'm talking about interest rates now. Dividends is the next thing. But before we get to dividends, there's a thing called hard to borrow. So hard to borrow comes about when a lot of people are short selling a particular stock. It doesn't happen that much in Apple. It happens a little bit though. And so what that means is people will offer their shares that they own to a short seller and for a fee. And that short seller will then sell the stock, pay for the opportunity to do that, and a different amount. And then and if more and more people are doing that, the stock becomes hard to borrow, and the interest rate goes up and up and up for that particular stock to sell that stock. So it only happens in a few stocks, but it's an important thing to mention. So there's a hard to borrow component. There's just the actual interest rate, which is not quite the risk-free rate. And now we could start to talk about dividends. Apple does have a dividend, as you can see by the D out here. And that dividend's 26 cents per share. And so let's talk about dividends for a moment. So dividends might sound easy, but if once you start getting into it, you'll quickly realize that there are its own battle to get the dividends right. So ORATS very quickly, actually, when I was a market maker, we'd almost have, we kind of dedicate a person to dividend analysis. So like we use a Bloomberg terminal, so that was pretty good, but we also used implied dividends because we had such good methods of put call parity. So when, for example, if you're off on your dividend assumptions, you're going to see a widening of the calls versus the puts. So we would analyze that relationship and if that was off, we'd go, that would give us pause to go look at that dividend. So now ORATS has a dividend consultant, full-time dividend consultant that works on the dividends and make sure that they're all good. And it's getting very difficult. I mean, with ETFs and multiple times per month, and it's pretty crazy what's going on right now. But we have discrete dividends that we feed in, and so that's the other thing that makes it difficult, Tyler, is the dividends. But again, we have a very good way to deal with those.
Yeah, it's amazing to hear just how many more things go into this than what appears on the surface.
Yeah, so I mean, ORATS, we sell our dividends. I mean, we get like 12% of our revenue are from selling our dividend feed. So that's a very important part of options. Like, you need to have a very good dividend feed. We want to control it, so we not only sell it, but we're working on that all the time.
Right. I think it's important. I've known you for several years, but a lot of the audience, might not know this, but you are a market maker for a while, and so you're bringing this knowledge that you learned on the floor, and we're pricing things kind of with that market making experience, and so this is very valuable to a lot of retail traders, because you're kind of getting that insight into the how people price things on the floor.
And truth be told, I avoided dividend stocks. We had people that loved dividend stocks and went into pits based on the dividends paid. The reason I avoided them is because you were always exercising, or you were always watching for conversions or reversals that would get you long stock or short stock. So then you'd just get pummeled if you were wrong in the dividend assumption. And so I always like more of the theoretical values that we're talking about here, rather than trying to figure out a dividend. So I avoided the dividend stocks. But some people made their market making money based on these dividends. So it's very important. People need to understand there's exercise risk. Like, if a dividend's coming up, you might need to exercise and get long stock in order to enjoy the dividend. So you have to watch out for that. But again, that's a little bit beyond this. We're talking about what's the true value of an option. So the true value option really depends on the dividend, and so so that's another one of the things. So now you have your 5 things. You have your dividends and interest, and time and strike and stock price. But now you're solving for implied volatility. So we have a good model to solve for implied volatility. If the implieds are off systematically for the calls and puts, we'll do a thing called a residual yield, which will shift the calls and puts closer together. And sometimes we'll even slope the residual yield, meaning sometimes the implied interest rate at lower strikes is different than higher strikes. So we do a lot in order to get the residual yield to line up the calls and puts. But once we have that, you get something looking like Apple, where you can then start to now the hard part becomes drawing a good curve through this. So that's the next step. Once you have the calls and put implied volatilities lined up, now you have to draw a smooth curve through it. And also, we want to have parameters on the curve so we can then do the next step, which is forecasting volatility and forecasting skew and forecasting the shape of the strike by strike volatilities, and not only that, but the term structure of volatility. So you can see that it's just getting more and more complex, and why it's so difficult to do what we're doing, Tyler.
Yeah, it really shows this process, finding the true value of an option, is the first step, and then ORATS over the last 20 something years has just been progressively building on that. We've created 300 million back tests as well, and we couldn't have done that without being really confident in our Greeks and implied volatilities and indicators.
Right, and the indicators are based on the term structure, but that's based on the skew structure of particular months, because you can't get a true good at the money without doing this kind of curve, and where that curve crosses the 50 delta is what we call the at the money implied volatility. So very important to do. This is the blocking and tackling, to use a football analogy. The fundamentals for option pricing and for putting out data is this what we're talking about right now. And it's very difficult to do. I talk about it pretty freely because I know that anyone starting this, it would cost millions of dollars for them to really do it at the level that ORATS does it. But yeah, let's keep talking about, so now we're to a point where we've got a good skew. This skew we've drawn through these calls and puts implied volatilities. So that's actually, a very good kind of, like, that's the SMV. When you're trading, that's what you want to be looking at. Now, so I don't know if you want to put a pin in that, or you want to look at some examples, because I also want to talk about term structure, earnings, and forecasting. So what would you like to talk about? What makes the most sense, Tyler?
I mean, we can look into term structure and earnings. I mean, that's
Okay.
kind of the next thing, right? With once we find the true value.
Right. So when we're talking about I'll turn on my drawing tool. When we're talking about now, we've got a good, we've got this orange line that goes through the strikes. And then, but where it now becomes an important line where it crosses the 50 delta. I mean, we also look at the 5 delta, the 25, and those are all important as well. But where it crosses the 50 delta is what we call the at the money volatility, and then we can then measure that for each month. So, like, if you look at this, this is the January 2nd expiration. So January 2nd expiration is here. And if I drew that line correctly, the 19.8 goes there. So now we have, this kind of term structure, but you could see right here, like, there's a big jump, and you don't normally want to see jumps without an explanation. So there's a jump between the 16th of January and February 20th expiration. Did you see that, Tyler?
Yeah.
So what's that from?
That's the earnings.
Yeah, so that's a good point. So now, there's a dividend, but the earnings is the big thing. So what we'll see is this kind of jump into the earnings month. Now, it's pretty far out, so it's not as pronounced as other ones, but this is extremely important, because then we do things like, we'll say, well, what is the, if there's a difference, people will want to know, well, what does that imply the move is going to be? Because we know there's going to be a large move on earnings just based on historical observations. But what the market makers will do is they'll know how to transform a volatility differential into a estimated move in the stock, and they're actually quite accurate at it. So, in this case, we could say, well, that 3% difference translates, and we'll go to the earnings tab here, to a 3.9% expected implied move for Apple after the close on that January expiration. Pretty interesting. And that's actually kind of right at the average and a little bit higher than last time. So that's another thing to put into. So now we're kind of going from the smoothing and SMV that you want to look at when you're trading. But that's when you're making a trade. But when you're like stepping back and looking, is this cheap or expensive in a longer term? Like, the SMV is kind of a shorter term, like, hey, should I trade this, or where should I trade this, on a short term. A longer term is, well, how is the implied earnings looking? How is that volatility looking? And then you could look at other things as well. So that's the big thing about that relationship, is then there's an implied earnings, and that implied earnings moves over time. But there's also just the overall level of volatility. Now how does that look? And we in the trade builder we could look at, okay, so here's the blue is the implied volatility, and the red or pink is the historical or actual volatility. Because what you're really trying to predict, either in an earnings move or on an implied volatility, is how much the stock is actually going to move. Because you'll want to, when you own options, you're paying a theta. So we used to do this technique to calculate volatility, where we simulated owning gamma by owning option positions, and then we would simulate, and then we would move the stock with, as the stock moved, and we would simulate hedging and turning that profit into a volatility. So it did the profit that we were making from our simulated gamma hedging exceed the theta for the options going down to ultimately to either zero or what the intrinsic amount is. And so I know that's pretty heady, but that's essentially what you're doing when you're buying implied volatility, or at least market makers will do that, and that's what kind of keeps the market price of the implied volatility near the historical volatility. Now, it's a mouthful. I don't know what you think about that, Tyler.
Whew, yeah, that was a lot. I mean, lots of tricks of the trade, and I'm just happy that we get the very diluted value adding stuff at ORATS. I mean, I was telling you this yesterday. I love looking at the SMV because I kind of know what I should send the order at rather than getting screwed over on the fill. I've been trading for many years, and I think I share the sentiment that a lot of retail traders do about always getting screwed on the fill. And this is why I started using ORATS and looking at the SMV before I send the trade, and I can be very confident about that price that I'm sending it at, because the market makers and the algorithms are looking at the same data, basically.
Yeah. So no, I appreciate that. So we were talking about kind of illiquid, thinly traded stocks, and how the SMB is really illustrative in those types of things. So, for example, in this stock, which is Gemini, which is pretty thinly traded and moves very volatile, the market's 10 cents at 30 cents. I mean, that's 3 times. I mean, think about how much kind of edge you're giving up there versus like the SPY, which is a penny or two. So you have to be very careful where you're going to get into this trade, right? And market makers know this too. So what is it? 10 is it 20 cents good? It's hard to say. ORATS, we do our best to try to draw a line through that. We think it's only 17, so we think it's down here. We don't think that paying the mid market is that good for this particular option. As a matter of fact, I probably would get usually I would give some edge to the market maker in order to get filled. But in this particular case, I probably would just trade it at the mid market, because you probably get filled. You probably get filled easier because they kind of have their own SMVs, their own theoretical values, and often they're pretty similar to what ORATS is doing. I mean, I know a lot of people that are still market makers in these big firms. And now it's 16 cents, right? Now it's the bid ask is staying 10 cents at 30 cents. And now it's 16 cents. So you're really giving away a lot if you try to trade it, at a certain amount. And especially if you're doing like a spread, you could end up paying, losing on both ends. So you have to be very careful. And, I think it's irresponsible not to use a theoretical value when you're trading. And I think a lot of these brokerages should be helping out their clients, because otherwise you're just giving, you have very little chance of profiting if you're giving away this much edge on the open, Tyler.
Yeah, and even if your broker, doesn't have ORATS integrated, that's why we integrate with a lot of brokers here, including Tradier. So you can connect your broker on ORATS and use this amazing feature, the SMV, valuation of the option, in this nice little trade sidebar that Matt has pulled up.
Yeah, and I think that's why we're getting a lot of people signing up. We're getting a lot of retail coming in and institutionals coming over, because institutional clients are having to pay so much for front ends, but ORATS has very good performance, and they'll come to ORATS. But also pro-tail or retail people will come up from brokerages, because they'll realize that they're giving up a lot of their profit by not using some of these analytics that are critical to have while you're trading. So again, I think it's irresponsible not to provide some type of a smooth value. We also do that thing that that we were talking about for forecasting volatility, and so we create these theoretical values, so you can kind of look at what the value is. Now, you're never going to be 100% accurate on it, but like, all you want to have is just in an R squared situation, R squared of 100's a perfect fit, and 0's not a very perfect fit, and 50-50, 50% R squared is generally not very good. You can't get to, if you're trying to predict future volatility, you can't get anywhere near even 50%. But even there is better than not doing anything. So,
Right.
Which is to say, we've done a lot of back tests with forecasts, and it's helpful in creating more profit by looking at the forecast. So it's a very difficult thing to do. I'm talking now about this forecast, but it has shown up over many trades as having some edge. The smooth edge, however, that's more concrete, more of a something that you would give up right away if you didn't pay attention to that smoothing edge, Tyler.
Yeah, that smoothing edge kind of goes back to what we were talking about when we just pulled up this stock, right? Is what are we overpaying or underpaying for this option based on all these factors that we talked about since the beginning of the video?
And look, it's really difficult, right? So we're trying to draw a line through these like scatter plot. These are horrible kind of. It's very difficult to get anything related, but you have to try. And there are enough that you could draw some type of a line through. We do put the confidence in there. So we have how confident are you in in this one? There aren't that many dots. There aren't that many implied volatility. So your confidence is low. 10%. It gets up to the highest one is 70% over here. You could tell that that's a decent fit there. So so the smooth values have an associated confidence that go with them that you should be paying attention to too. I know it sounds very difficult, but these are just, if you remember just a couple things from this conversation that we're having, is try to get a theoretical value. Try to establish some confidence. I mean, when you're trading Gemini, Tyler, you're going to have a tough time finding a lot of confidence, because there's the market makers don't have a lot of volume to go off and lay off their risk. So someone traded 171 of these 13 calls today in December 12th. The open interest was only 65. So what are they going to do? They have to raise the price of these, and so the theoretical values are going to jump around based on supply and demand, because you can't really hedge it very well. So you're going to see, you might be asking why are these situations existing, and the problem is it's not very liquid, and market makers are kind of trained to like move things, to make people pay more and more if they're going to get the market makers holding more risk. So that's why you start to see these dots or values all over the place, is because there's not that much liquidity. The stock's moving around a lot. Market makers are having a difficult time, making money in a particular stock, so they're they're going to kind of fight their position. Meaning, if you're going to buy more of these or sell more of these, it looks like, if we could figure out, let's see, 13s. It looks like it's part of a spread. But if you're going to be trading these, you're going to have to. The market makers are going to have to pay more and more over the SMV in order to trade it.
Yeah, it's all really cool stuff.
Yeah, that's a mouthful, but
yeah,
these are all things that if you ask someone what is the true value of an option, we kind of answered it in two separate ways. We said, well, immediate, that smoothing, that orange line, is a way to determine what the market makers think about value. But then you also have to think about, well, how much is the stock moving? What are the earnings? All these other things. That becomes our forecast of volatility. So that's longer and that's much less certain. But you still want to have some confidence in both. And then we present the confidence. And then when you start to trade, you could have more confidence in getting this more on your side. I think you'll find your trading improving.
Awesome. All right. Thank you, Matt. Thank you for sharing all of your market making experience and for wrapping it up into ORATS and, building it into what it is today. I think this gives the retail trader a tremendous amount of value, especially when it comes to feeling good about the trade prices that they're executing at. And you can do that with the SMV price. So thank you, Trader, for hosting us again this week. We'll see you guys again next week. If you have any questions, please email us at support@orats.com. Or if you want more immediate answers, you can ask our AI chat agent called Otto in the top right of the dashboard or the website. Otto knows everything about SMV and the true value of the option. And we've taught it all that we know about options trading in the SMV and things like that. So unless you have anything else to add, Matt, thank you guys for watching, and we'll see you again next week.
Thanks, Tyler.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.